Asking if inflation has peaked is the wrong question to be asking. Now, all of life is always knowing which questions should be asked. And while everybody's looking at the Fed, looking at the data and asking if inflation has peaked or will inflation go down, wondering what the central banks and the Fed will do next, I think they're looking, or I should say asking, the completely wrong question. So in this video, I'm going to break down the real data of what the Fed is looking at, what the Fed is up against. I'm going to show you why asking if inflation has peaked is completely the wrong question. I'm going to show you the right question that you should be asking, and I'm going to show you my base case for what I think happens moving forward and what I'm going to be doing about it. So let's go. All right, welcome back to the channel. I know it's difficult to understand what's going on in the world today. You're looking at all this data, you're probably watching a bunch of other channels, reading a bunch of news sources, and it gets confusing. But don't worry, I got your back. I'm taking these very complex subjects and making them very easy to understand and even actionable. And in this video, I'm going to show you what I expect to be my base case, what I think is probable to happen, and we'll have a rough overview of what you could be doing about that. Now, if you want a deeper dive into what I'm doing based off of my base case analysis, I'm doing a live event. You can come hang out with me. It's about an hour. I'm going to run through a whole bunch of charts and graphs. I'm going to go into Q&A. You can ask me any questions you want. It's free. You can check it out. There's a link in the description below. But let's go ahead and just jump into this video. All right, so we'll start with inflation. Obviously, you already know this. Inflation's all-time high. Duh, right? We know that. We can see that we're at a 40-year high inflation. The last CPI print was 9.1%. We already know that. I don't have to tell that to you. But we know that the Fed is focused on this. Now, the first thing I want to show you, I love to show you the charts and graphs on this because I want you to see the rate of change in the direction. And so here we are back in like 2005, and you can see how much inflation has changed over time. Crazy how high it is at this point. But this is consumer price index right here. It's been going up, of course, right here after the 2020 crash. These gray lines are always recessions. This is 2008. It went up and went back down. Remember that. We're going to talk about that. And then we can see it dipped right here in March 2020. All right, that's inflation. I don't have to tell you. You already know that's high. But what we want to focus on is what is the Fed focused on? Inflation, right? They're focused on inflation. If they can see meaningful change in inflation, then they could pivot. So everyone wants to know, when is the Fed going to pivot? When will they bring liquidity back to the markets? And so they're focused on CPI, right? They're focused on inflation. And has inflation peaked? And remember, I'm saying that's the wrong question to be asking. So the Fed's looking at it. Inflation takes over as the next big focus. The next big focus for the markets after July's monster jobs report. Now, I just did a whole video on the jobs report and how it was completely manipulated data, or as I like to call it, factually accurate, but intellectually dishonest. We'll link to a video up there. If you missed that video on the jobs report, you should go watch it. But now, after the jobs report, they're focused on inflation. All right, but I want you to be aware of this definition first. I always like to use definitions so we're clear on what we're talking about. You might have heard these two words being thrown around, so I want to make sure you're clear on these. Deflation versus disinflation. Okay, this is a very key piece here, pivotal. All right, so deflation should not be confused with disinflation. Those are two different words with two completely different meanings. Deflation is a decrease in general price levels. Disinflation is what happens when price inflation slows down. Big differences. Deflation is the opposite of inflation. So inflation is prices going up. It's not what I consider to be inflation. Inflation is increase in monetary supply. But in terms of this discussion, CPI, consumer price, is the prices going up. So that's inflation. So the opposite would be prices going down. Sounds really good, right? Wouldn't we all like prices to go down? Of course, that's not what really happens. What happens is disinflation. That's, on the other hand, it shows the rate of change of inflation. So what the Fed wants is, right now we're at 9.1%. Prices are going up by 9.1% per year. Of course, that's completely manipulated. However, if they can get it to 7.5% or 6.5% or 5.5%, they're going to consider they've done a really good job. But what that means is that prices are still going up, just at a slower rate. That's disinflation. It's not that if they get prices back down to 2% inflation, which is their target, things go back to being cheaper like they were before, our quality of life goes up. That's not the case. They're still going up, just at a slower pace. And I want you to remember that, okay? We're going to come back to that. All right, now we know that the Fed has been trying to raise rates to, of course, get a handle on this inflation. And what they've done is that they've kept their rates artificially low for a really long time. And this is part of what's caused the problem. You have to understand how this problem got created. Now we can see this is the Fed funds rate going back all the way here to the Paul Volcker moment. Remember, inflation was raging high and Paul Volcker had to raise the Fed funds rate to almost 20%. That's the big, great myth, as Jeff Snyder would call it. I did an interview with Jeff Snyder discussing it. We can link that video up here where Jeff Snyder says that the Volcker is all a myth. Anyway, we can see that since this time, nothing goes in a straight line. But what we can see is that it almost looks like prices, or I should say rates, have been coming down in a straight line. After the 2008 great financial crash is this gray line. We can see rates basically hit zero and have stayed on zero ever since. They tried to, when Jay Powell took over the Fed, he tried to normalize rates and they went up a little bit. It caused a crash, and of course we've been at zero, and now the Fed's trying to come back off of that. I want to just explain that to you a little bit so it makes sense as we move forward. But because of this, are they going to continue raising rates? Fed's Bullard sees more interest rate hikes ahead and no U.S. recession. Why? Because the economy is doing really strong per that jobs report. We linked that video. All right. But again, has CPI peaked or is it coming down? That is the wrong question. Have inflation rates peaked? Again, that's asking the wrong question. Don't worry, I'm going to show you the right question to ask. If you're liking this video, by the way, hit the thumbs up on this video so more people will see it. And while you're at it, hit that subscribe button and the bell notification. Hopefully my likes haven't peaked yet. I'm trying to get more subscribers. Can I get more inflation to my subscribers? Help me get some inflation there. All right, so when in doubt, I like to say, let's zoom out. All right, if we zoom out, we're going to see a much clearer picture. It's like as you're getting older, your eyesight starts going out and you have to kind of look at things a little bit further. All right, now something I talk about quite often is an 80-year financial cycle. I talk about 3 cycles that are converging: 250-year political, 80-year financial, 50-year technological. Editor, let's link the playlist of those 3 videos up here. All right, but we're talking about this 80-year financial cycle. Now, this is key for you to understand, of course, in context of the other 3, but this is the key to understanding where things are going. All right, we are looking at a sovereign debt bubble bursting. Sovereign, a nation. Potentially the first big sovereign debt bubble bursting in about 80 to 100 years. That's what we're facing right now. Now you can see these bubbles. By the way, I got a lot of these charts from my buddy Luke Grommen. You guys should go check him out on Twitter, Luke Grommen, or Forest for the Trees. So shout out to Luke Grommen, check him out. All right, so he says the first sovereign debt bubble in 80 to 100 years. And what we're seeing here is the green line here are emerging markets, and the orange line here is the US. And so what we can see is these debt bubbles have gone up and down. This goes back to World War I. This is before World War I. This goes to World War II in the 40s. We've talked about this extensively. I've shown it in a bunch of other videos, showing how the government had to take on massive amounts of debt. But we can see how it's come back down. Of course, they used a trick to get that back down. We talked about it in a separate video. But what we can see here is that the sovereign debt of the United States is so ridiculously high at a time when the emerging markets have come down. Of course, the emerging markets are dropping like flies. Think Sri Lanka, Ecuador, Peru, Lebanon, etc. You get the point. But you can see the levels of debt that we're in. To show you another chart, I love to look at this one. This really illustrates this. So World War II, remember I showed you that big asset bubble? Well, that was right there. This is 1971, of course, when we came off the gold standard. And look how much debt we've taken on since then. It's a massive amount of debt. Now, when debt gets that high, governments don't have a lot of options to get out of this. As a matter of fact, I just recently did a video where I talked about what options they have. There's 5 options, and really there's only 1 option. So go back and watch that video if you want to know more about that. But what we have is from an IMF paper, International Monetary Fund. They wrote this paper in 2015 called The Liquidation of Government Debt. And they spelled out how they can get out of debt. And of course, it's the playbook they used in the 40s, and it's the playbook they're going to use again. So go watch that video if you want to understand that. But basically what it is that they would keep rates really low and inflation really high. So you end up with real rates. So what does that mean? So right now inflation is at, let's just use round numbers because I'm not super good at math on the fly. Let's call inflation at 10% and bond rates at 2%. So you're losing 10% to inflation, but you're getting 2% in your bonds. So you actually have a negative real rate of 8%. Does that make sense? And now, how negative could they get? Well, in Japan, we saw them at negative 60%. We saw massive. Here we saw them at about negative 20%. In the US, we saw them back to the 40s when they've done this before, negative 15%. That's how bad they could get. So just know, one of these tools that they have could see rates going that low. But let me show you how this works. Okay, so there's 4 ways out, but really there's only one in my opinion. Go watch the other video for the whole example of this. But what they want to do is they want to try to grow out of the debt, right? So if they've lost $1 worth of growth, they want to take on 50 cents worth of debt, and that 50 cents of debt would hopefully get them the dollar growth back. Now that works until they reach a certain amount of debt threshold. Now, what we can see is after World War II, this is from 1950 moving forward, this blue line here is the gross, that's GDP. So the growth, GDP has been growing. You can see this trend line going up, this blue line right here. This red line down here is the debt. So since the 40s until here about 1980, it worked. The government was able to grow its way out using these tactics and a little bit of engineering. But the reason why it worked is because the economy was growing faster than what the debt was at. The problem is that since then, what we can see is that the growth is 500 to 800 bips below the growth. So now we can see the debt is up high and the growth is down low. So we're not growing anywhere fast enough to get out of this debt. In that other video that I referenced, I broke down the math and explained how that works. So I'm not going to run through all that math for you again. All right, now we have to think about the interest on the debt. So we talk about this massive amount of debt we have. Over $30 trillion of government debt, hundreds of trillions of dollars of debt when you take in unfunded liabilities and things like that. And the problem is this true interest, the true interest. And this is a big problem. I have a chart for you right here. Now, the true interest is the amount that they owe on the debt, but it's we have to take into consideration other things that they owe, mainly social programs and entitlements. And the problem is that when you take just the social programs, these are the welfare, food stamps, etc., plus the entitlements, the Medicare, Social Security, etc., when you take just that alone is 100% of tax receipts of the income. So the government has income coming in from taxes from us. Of course, they just spent $80 billion to go hire 84,000 more, or 84 million more, 84,000 IRS agents to go get more tax out of you. So that's the revenue coming in. But what we can see here is the true interest expense as a percentage of US tax receipts. Right here, we're already at 100%. So what we can see in March of 2020, it got up to about 120%, and that's because tax receipts sharply fell. Of course, surprise, surprise, you shut down businesses, you shut down people working, tax receipts plunged. So it jumped up to 120, but we're sitting at about 100%. So just for those things alone, all of the government revenue is taken care of. Now, we have to also take into consideration that this is a time when CPI is greatly exaggerated, and we have this massively overinflated GDP. So you have to also take this into consideration. We have this outlier year. All right, now, tax receipts. Let's break this down for a little bit. Where do the tax receipts come from? Because we have to understand that's the income, right? So if income is going up, then we could grow our way out of it. If income is going down, that's a problem. All right, tax receipts are set to plunge. It's not a good problem to have, is it? Not a good problem. And it's because of the Fed's war on, or what they're trying to exert is a reverse wealth effect. So a wealth effect is when your retirement account goes up and your home value goes up, even though you're not planning on selling those things, you're not going to retire for however long, you still feel more wealthy. When you feel more wealthy, when you feel things are going to be better in the future, you spend more money. You take vacations, you go out to dinner, etc. When your stock account, when your retirement account goes down, your house goes down in value, and you feel worse about the future, then you spend less money. So the wealth effect is feeling more wealthy. The reverse wealth effect is when you feel more broke. And that's exactly what the government is trying to do. We can see here a headline. I've shown these multiple times. The Fed must inflict more losses. They have to steal your wealth. They have to crush you. Look at the words. Must inflict more losses on stock market investors to tame inflation, says a former central banker. They must crush stocks to tame inflation, meaning they must have a reverse wealth effect. Well, if they have a reverse wealth effect and they crush stock portfolios, what happens to their taxes, to their income? Well, I'm glad you asked. Let's take a look at this. So what we can see on this chart, tax receipts are barely covering true interest. As a matter of fact, like I said, just that true interest, those minimal amount of expenses the government has to spend are already 100% of their tax receipts. All right. And what we can see is that tax receipts are likely to follow asset prices. So the Fed is trying to do a reverse wealth effect, crush asset prices, stock prices, real estate prices, asset prices. And what we can see, here's the year 2000. This blue line here is stock prices. And this red line down here is tax receipts. So when we see this right here, stock prices peaked and started going down, what happened to tax receipts? They went down. Here we can see it again. Stocks peaked and we can see they both went down again. We can see it again. Now what happens here? Stock prices are at an all-time high. We have tax receipts already starting to go down right here. So as these stock prices, as asset prices come down, where do you think tax receipts go? Well, even a third grader could spot this pattern. If this happened here, this happened here, this happened, what do you think happens next? If you guess tax receipts go down, you would be right. But the problem is 100% of those tax receipts are going to pay for that program. Now, a lot of this is cause and effect. If we have a time machine, we can go back in time and, oh, don't touch that because one small move could have this massive shift on the future. And that's exactly what happens all the time. We can go back to 1995 to see what Bill Clinton did. Of course, the law of unintended consequences. And they wanted to get more money. So they thought they would increase taxes. So they said, hey, here's a plan. Hey, big corporations, what we're going to do is, you know, when you pay your CEOs and your executives all this compensation, you know what? As a matter of fact, you can't pay them any more than $1 million. Anything over $1 million, you can't deduct off your taxes anymore. So you can still pay them, but it's not tax deductible. So, okay, guess what happened? Then corporations don't pay anybody more than $1 million. You see, you never get the taxes you think you're going to get. They're like, oh, we're going to get so rich, we're going to tax everything over $1 million. Corporations just said, okay, then we're not going to pay anyone over $1 million. What they did instead was they gave them stock packages. So they gave them stock packages because at the time, those extra stock packages weren't liable for taxes. Surprise, surprise. Now, since 1995, we've seen these massive programs of giving these CEOs and these executives stock, which has allowed them to get really rich. But what happens when stocks start going down and we need the income from those stocks, which a majority of their pay is from? If you guess tax receipts go down, you would be correct. All right. Now, let's also look at consumer spending, which is also where we get our taxes from, our tax receipts. Now, consumer spending can't rise without asset prices going up. That makes sense. Part of the reason why is because real wages have actually been going down since about the 70s. And so what that means is that even though it looks like you're making a little bit more money, it hasn't kept up with the price of inflation. And so that's why I'm saying real wages. And so what we can see here, if we look at the GDP of the nation, we can see that about 70% of the GDP comes from personal consumption expenditures. All right, I'm not going to dig into the rest, but what I want you to understand is that it comes from consumer expenditures. But what we can see is that consumer spending can't rise unless stocks are rising, because what we can see on this chart is that the net cap gains distribution, remember, those wealthy CEOs and executives that get paid in stock packages, and when your assets go up like your house or your Bitcoin, you have capital gains, right? So the net cap gain distribution plus IRA distributions as a percentage of year-over-year growth. So what we're seeing is that right here, 200%. So 200% of growth is coming, 200% of growth of the personal consumption expenditures that we need for the GDP to go up to get the tax receipts, 200% of that comes from net cap gains and IRA distribution. So if asset prices aren't going up, then guess what happens? Then there's no net cap gains. And if there's no net cap gains, then there's no personal consumption. If there's no personal consumption, which makes up 70% of GDP, then there's no tax receipts. Are you following along here? And it gets even worse or better depending on how you want to look at that. But what we can see is that the way taxes are paid is not even. It's not even at all. As a matter of fact, we can see the top 1% of taxpayers pay 38, almost 40% of taxes. If we look at the top 5%, 60% of all the taxes in the United States are paid by just the top 5%. Now, I hate to break it to you, but the top 5% of earners most likely don't earn on a W-2 income. How do they get paid? They get paid with stock packages, they get paid with assets, they get paid in other ways that are not taxed as W-2 income, which again goes back to the personal consumption, tax receipts going down, stocks receipts going down, and that puts the government into a very serious situation. All right, so now you understand why I say asking if inflation is peaked is the wrong question. So what is the right question we should be asking? Well, the right question we should be asking is, will the US government allow the bond market to bankrupt itself? So what do I mean by that? Now remember, we talked about the 4 ways that the governments can get out of this debt situation, and really the 5th way that I think they're going to take. So this is the question to ask, is will they allow the bond market to bankrupt itself? The bond market is how they raise debt. So if tax receipts are going down, so already tax receipts only pay for the bare minimum, tax receipts are going to be going down because the Fed is bent on pushing asset prices down. Hopefully you're following along. So will the government go bankrupt? Sorry, we don't have any money, we can't pay our debts, and we can't pay for any of these things, and we're broke? Now, what do you think the odds are of a government that can print their own currency going bankrupt? It's just barely better than 0, in my opinion. It's pretty much not going to happen. Of course they're going to print money, they're not going to be bankrupt. So if they're going to print money and not go bankrupt, then why would anybody store their wealth, store a value, in bonds? Why would any nation store their wealth in bonds when they know the government is going to be forced to print money and devalue that debt? Why would they do that? Well, it's a good question to ask. Let's dig in a little bit further, because this leads us to what we should be doing in the future. All right, Mr. Market. So I asked you the question, do you think a government that can print their own money would choose to go bankrupt? And of course, I believe the answer is no, but it looks like Mr. Market also believes the answer is no as well. Why do I say that? Well, we can see that the price of gold is up and the rates are up at the same time. So what do I mean by that? So typically, gold works opposite of real rates. And so we can see them moving back and forth like that. But right now, even though rates are going up, gold is also still going up at the same time. So typically those move inverse of each other. So we can see, I didn't put the dates on here. I think this is 2008 right here. What we can see is gold has done pretty good. Now, I know a lot of you guys hate gold. That's okay. I'm not telling you to buy it if you don't want to. What I'm saying is the market in gold is telling us that they don't believe the Fed will go bankrupt. Now, why is this important? You may not like gold, but what do sovereign nations and central banks around the world buy? Well, where do they put their money? Well, if you said gold, you would be right. So you may not like gold, you may not want to buy gold for your portfolio, that's okay, but the sovereigns still consider that to be money. And what we can see right here is that central banks were buying treasuries, but here they became net buyers of gold. And look how much gold they've been buying. They were buying treasuries before, and now they're buying more gold. So again, you may not want gold for your portfolio, but the central bankers are buying it. Now, if the sovereign bonds fail of being a store of value, because of course they're not going to go default and go bankrupt, then where else as a sovereign nation or as a big institution will you put your wealth? And that is where things get interesting. I put this note here, reserves for future energy. At the end of the day, what we all need is not money. We need the things that money buys us. And ultimately, what we really need is food and energy. Look at Sri Lanka. Sri Lanka completely collapsed. They defaulted on their bonds, and they couldn't pay to bring food or energy into the nation. We need energy. No matter how many greenies tell you that we don't, we need energy today. And so what's going to happen is as those commodities get more rare and as they get more expensive, we're going to need money to buy those things. And you're not going to want to store your wealth as a sovereign in a currency that you know is going to be deflated away, which is exactly what's happening. All right. Japan or Argentina. Now, a lot of people love to point to Japan, Japanification of America, of where America would go. The reason why is Japan is about 20 years ahead of us. They started buying up all their own bonds, and it's a perfect example of where the United States could go. Or could it be Argentina, a nation that continually goes bankrupt over and over and over, I think 9 times at this point? All right, so what happens is, as the central banks are going to be forced to loosen their policies. Why? Why would they be forced to loosen them? Well, I made the case. They don't have enough income coming in to pay their minimum expenses. So they're going to have to take on more debt. So they're going to have to start to loosen. But the problem is they're going to be loosening at the time of us having inflation. So what the Fed's trying to do is they're trying to raise the rates enough when they think they can allow it before the market crashes, so it gives them a little bit of room to come back down. That's what they're trying to do. But the problem is they're going to be forced to continue to loosen even when inflation is raging, which is why saying has inflation peaked is the wrong question to ask. Inflation has not peaked. The Fed is going to be forced to loosen no matter what the inflation is. And that the reason why is the Fed will be forced to buy more of its own debt. So here's a chart I have. This is the US and Japanification. Now the blue line is Japan, the BOJ balance sheet, and the red line is the Federal Reserve balance sheet. Now you can see they've been kind of moving along together right here, but we can see Japan really took off right here. But what we're looking at, the reason why I show you these charts is so you can see the direction and the speed at which these things are moving. And now you can quickly see the Fed is turning up and really trying to catch up with Japan right there. And the reason why this is really going to go hard onto the government is because this shows the blue line is the U.S. federal debt and the red line is the foreign international holdings of U.S. federal debt. So who is buying the debt, the bonds? The government needs money. It has to take on debt. Who's buying it? What we can see is the foreigners buying federal debt has flatlined. Foreigners don't want that debt no more. They already know the answer to this. They already know the answer to the question that I'm posing to you is when a nation can print its own currency, they're not going to default. They're going, and they can also see the problem that tax receipts are going to go down. The government's going to have to continue to print more. So they're not buying that debt. So who's buying it? The government. Do you see the problem that we're in? Now we can see it broken down in numbers a little bit differently this way. And what we can see is that right here, so this is 71 to 85, 14% of US debt increase was sterilized by FX reserves or bought by the government. We can see here in 1985 to 2002, 28% of the debt was bought by the government. But here in 2002 to 14, 53% of US debt. So who's going to buy the debt? The government is going to buy their own debt. Now, I'll show you a couple other charts. Actually, I want to show you this other chart. We talk a lot about the reserve currency of the world. What does that mean, a reserve currency? That means that it's where people store their reserves. That's where they store their savings. But again, why would they store them in a currency that they know is going to be devalued and debased? Well, one, if there's no better options, one. And that's really the only one, right? And what we can see is that no reserve currencies have lasted. And we can see that the reserve currencies have changed. So we can see that the US, UK, the British pound was the reserve currency of the world before the USA took over. Now, the USA has taken over for a long time now. The pound sterling is still around. It's still there, still being used as a currency today. It's just no nation is storing their reserves in that wealth, if that makes sense. Now, what this leads to is this balance of payments vortex. I'm doing my best George Gammon, actually drawing out a whiteboard for you here. But we have the US deficit. So this is the deficit. So this is the shortcoming, the amount of money that's owed versus the amount of money that's coming in. As I've broken it down to you on the receipts are going down. So the deficit will grow, because we have increasing amounts of debt and then we have tax receipts going down. So when that happens, that's the environment that we're going in. There's nothing that's going to change this. There's nothing that's going to change this. Tax receipts are going down. The only way they could change is if they went ahead and just blew asset prices back up. That's not going to happen, not right now. So tax receipts are going to go down, debt's going to go up. So then what happens? Well, then the US has to go borrow money. Obviously, the deficit, it grows. They have to go borrow money. Now, they need money for the central banks, and they can't do quantitative easing. So what are they going to do? Well, then it comes down here. The Fed versus the private markets. The Fed starts to crowd out the private investment. There's not enough demand for the amount of debt that the governments take on, so the Fed buys it all. They crowd it out. And then they have to start controlling the yield because the rates, the short-term and the long-term rates start going up. So the Fed has to start buying it down, sort of like Japan is doing, which then takes us to the next step of the vortex, which is that the Fed crowds out the borrowing markets and private rates start going up. This slows down the global economy as it comes grinding to a halt, which then does what? It reduces tax receipts. So then we go right back up to here, where we have tax receipts going down and more debt coming up. And you can see this vortex, this doom loop, just continues on and on and on. All right? This is my base case for what's going to happen. So what are we going to do about it? What's the playbook here? All right. So 1, expect more inflation. So has inflation peaked? I think that's the wrong question. The question is, will sovereigns default on their debt when they can print money? That's the question. And the answer is, of course, they're not. So I think that we should expect more inflation. Now, inflation could go from 9.1 to 8.1 to 7.1 to 6.1. That's fine. That's disinflation, not deflation. All right? Remember, nothing ever goes up in a straight line. So inflation can go like this. All right? These periods are called disinflation. But it doesn't mean it's not going to go back up. So I would expect that we're going to continue to see more inflation. I think that we might be seeing some of the lowest inflation we'll see for the rest of the decade. Now, remember, in a line, it doesn't go up in a straight line. I think that we'll continue to see bonds plunge because the government's going to have to continue to take on more debt. So they can't let the rates rise. They'll end up just like Japan, buying the bonds down, buying the yields down. Remember, not in a straight line, but in a wave like this. I am extremely bullish on energy and commodities. I've been saying it for over a year now. When they print unlimited amounts of fake fiat counterfeit money, people want to buy real hard things. The things that we need the most in the world are energy and food. And so I'm super bullish on those. I'm super bullish on stores of value, and that would be gold and Bitcoin. All right, so those are hard money assets, ones that can't be artificially inflated away. I'm also bullish on low rate debt. We've seen mortgage rates have come way back down again. If you can lock in 30-year debt at sub 5%, that's probably going to be very good when we go into this really high rate inflationary environment. And then finally, in this environment, I want to demand self-custody, because what happens when governments start going broke is they start trying to get their hands on every asset they can. In 1933, they seized all the gold, and it could happen again. So I want to demand that I have assets under my own custody, which of course gold and Bitcoin both fall into that. Investing into energy and commodities, that's the playbook. I know it's super broad. If you'd like to get more granular about what I'm actually buying and selling and ask me questions about it, there's a link in the description. You can come hang out with me as I run through the whole playbook and do Q&A. But this is my base case. This is what I expect to happen. I don't see any other way around it. This is my most concise view and thought on it. And I'd love to hear what you think. So leave me a comment down below. Of course, as always, give me a thumbs up on this video so the algorithm sends it out to more people. And while you're at it, hit that subscribe button and the bell notification so you know when I put new videos out. And that's what I got for you today. All right, to your success. I'm out. Since you've stayed to the end, I know you like this video, which means you're probably gonna really like this video right here and this video right here.